So what is the secret to a tax-free retirement? The tax code actually includes several moves that you can make to create a tax-free retirement income, but the optimal window may last only 5 more years. That's right, this is your wake-up call. Those who are the most diligent savers are sitting on substantial tax-deferred retirement savings, but it could be a future tax bomb waiting for Uncle Sam. Did you know that many retirees have less income than during their working years, but pay more in taxes? It was not supposed to be that way. You were told to take advantage of your company retirement plan and defer taxes while you were working until your retirement, when you would be in a lower tax bracket because your income would be lower. Well, guess what? In many cases, that advice has turned out to be a bunch of baloney. If you think tax rates are going to be lower in the decades to come, then please move on from this video. But if you think that we're in for higher tax rates, stick around and I'll give you the playbook to create a 100% tax-free income stream in your retirement. Hi there, Colin Exelby here, and I'm a certified financial planner professional. I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and provide advice virtually to clients all over the country. In my opinion, for many people in retirement, your taxes are going to be higher than when you were working. Let me say that again. Your taxes will be higher in retirement than when you were working. This is a really good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different, and you should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. So why will taxes most likely be higher in retirement than when you were working? Well, many of the tax deductions that you have during your working years vanish in retirement. Mortgage interest, gone. Child tax credits, gone. Retirement plan contributions, gone. But for many, it's likely that drawing down future retirement funds where you deferred taxes through traditional retirement plans will put you in a higher tax bracket than when you were working. These are what I call potential tax bombs. Look, when you defer tax payments today in a traditional retirement plan, you will pay taxes in the future. What's worse, in most cases when you turn 72, you are required to take money out of those retirement plans whether you want to or not. This results in required income, just like a paycheck, whether you need it or not. And if you forget to take it out, you're penalized 50% of what you were supposed to take out. Now, many Americans blindly defer taxes into the future and hope for the best. In addition, most of us will be eligible for Social Security benefits. Did you know that, quote, provisional income can make your Social Security taxable? That's right. In President Bill Clinton's first term in 1993, the Social Security tax was expanded so that up to 85% of your Social Security payments could be taxed. The taxable amount is based off of what amount of provisional income you have. What is provisional income? It's 1/2 of your Social Security income, any distributions from your tax-deferred retirement plans, like IRAs and 401ks, any 1099 capital gain or interest generated in your taxable bucket, any employment income, any rental income, and any interest from municipal bonds. The IRS then adds it all up and then computes whether your Social Security will be taxable. As of 2021, here are the rates of taxability according to the Social Security Administration. If you file a joint tax return and your combined income is under $32,000, you pay zero tax on your Social Security benefits. If your income is between $32,000 and $44,000, you may have to pay income tax on up to 50% of your benefits. And if your provisional income is more than $44,000, up to 85% of your benefit may be taxable. Now, the numbers are slightly different if you're single, and you can check them all out at ssa.gov. Okay, so now that we know what provisional income is and what the brackets are, how do we keep it as low as possible in retirement? Because this is the key to a 0% tax bracket. Well, one of the goals that many people miss during your working years should be to allocate the right amount to the taxable, the tax-deferred, and the tax-free buckets so that during your retirement, all your streams of income are tax-free or as close to it as possible. For more on retirement withdrawal strategies and the differences between the taxable, tax-deferred, and tax-free buckets, make sure you check out my video on the best retirement withdrawal strategies. You can watch it by clicking here. Here's the good news. With proper planning, you can do it. You can get to a 0% tax bracket in retirement. So how do we efficiently keep our retirement income as low as possible? Well, first, we take advantage of the tax rates today. The 2017 Tax Cuts and Jobs Act created some of the lowest tax rates for Americans in history. But they will not last forever. To create a tax-free income in retirement, first it's important to understand where we were and where we currently are. So let's take a look at these two charts side by side. The chart on the left shows the tax rates in 2017. The chart on the right shows the tax rates in 2021. For the purpose of this discussion, I'm going to focus on the married couple rates that are in the middle. What you see is that for most Americans, once you exceed the 10% tax bracket, current tax rates are lower. The former 15% tax bracket is currently 20% lower. It's at 12%. The former 25% bracket is 12% lower at 22%. The former 28% bracket is currently 14% lower at 24%. And even the former 33% bracket is 5% lower at 32%. It really isn't until you get to the 35% tax bracket that rates are higher. But what's really interesting is the changes to the income levels that allow you to be in those certain brackets. What I want to focus on are the two large jumps in the tax rates. You'll see from 12% to 22% and from 24% to 32%. For the married couple, when you have roughly $80,000 of taxable income, and remember, that is income after deductions, you don't move into the 24% bracket until you reach roughly $172,000 of taxable income. Compare that to the 2017 bracket when the income threshold was much lower at $153,000. And you know what's really wild? Let's look at the difference between the current 24% bracket and the 32% bracket, the next big jump. Until you make roughly $330,000 of taxable income, not gross income, taxable income, you're still in the 24% bracket. Compare that to 2017. You can see that you jump into the 33% bracket at only $233,000. That is a huge difference between 2017 and today. And other than the first $80,000 of taxable income at under 12%, this is the largest sweet spot in the tax code. So why is this so important to understand? Well, this tax law is set to be in place until 2026. From the date of this recording, that's 5 more years. And if Congress can't agree to extend them, and let's be honest, they can't agree on a lot, they go back to the 2017 rates. What if Congress decides to accept the current Biden tax proposal? Well, then tax rates could be even higher than that. In my opinion, it's a good bet that for now, tax rates are as good as they're going to get. All right, now that we know what provisional income is and what tax rates currently are, we have the playbook to craft a tax-free retirement income stream. Now for the fun part, let's start looking at calculations. For married couples who are both over the age of 65, the standard tax deduction would be $27,800 in 2021. This increases with inflation over time. The vast majority of American taxpayers claim the standard deduction on their tax return. If you have significant medical expenses or charitable deductions, you might itemize, but that list is getting smaller and smaller. And this is important because you can have up to that amount of provisional income without owing any taxes. That means that a retiree could take up to $27,800 currently from their tax-deferred IRA without tax if they had no other income. That would mean that you get the tax deduction on the way in, you get tax-free growth, and you can pull it out without taxes. Triple tax-free! That's amazing, and it's not really talked about. Now, how do you design your retirement savings strategy to maximize this? Well, your tax-deferred retirement account balances need to be at a level that, adjusted for inflation, by the time you are required to take the distributions at age 72, those distributions will be less than your future standard deduction. Follow me on that? Let's look at a hypothetical example. Marcia and Don are 55 years old currently. They're 17 years away from mandatory distributions. We're going to take the current standard deduction of $27,800 and we're going to inflate it by a historical rate of 3% per year for 17 years. When we do that calculation, the deduction will be closer to $46,000 when they turn 72 and are required to distribute from their IRAs. So at 72, if they didn't have any other tax deductions or provisional income, they could take $46,000 total from their IRAs without taxes. How much are they required to take? Well, the IRS has a nice, easy table to figure that out. I'll provide a link to that in the notes below. At 72, it's basically 3.9% of your account balance. So how large of a 401k or IRA could a couple have to distribute tax-free? Well, the answer is $1,179,847. And the way that you get that is a calculation. $1,179,847 times 3.9% equals $46,000. Or according to the IRS table, $1,179,487 divided by 25.6 equals $46,073. So a married couple could have roughly $1.2 million total in IRAs, and the distributions would remain tax-free. On the other hand, if they only had, say, $100,000 in tax-deferred IRAs and 401ks, their required distribution would be $3,906. That's a mistake. They would have $42,094 in unused deductions. So there is an optimal number to have in tax-deferred accounts when required distributions start in order to minimize your future taxes. And you can figure that out for your own situation by taking your current IRA and 401k balances. Calculate the number of years until age 72, add your contributions and any employer match over time, calculate the rate of return you anticipate making over time, and this will give you your potential future balance. Good financial planning software can help figure that number out. All right, in my opinion, it's easy to see that the tax-deferred retirement bucket has many advantages and can potentially be triple tax-free if you design your strategy appropriately. But there are also potential tax bombs that can eliminate your chances of having a 0% tax bracket in retirement if you bury your head in the sand and just defer and pray. Please don't do it. Okay, now that we know how to optimize your tax deferred bucket, let's talk about how to maximize your tax-free bucket. First, let's talk Roth. Everyone loves Roth, except maybe the government that created them. You may have heard how PayPal founder Peter Thiel put his ownership shares of PayPal in his Roth, and over the past 20 years, through appreciation, now has a $5 billion tax-free piggy bank. Warren Buffett has a $20 million Roth IRA at the end of 2018, and I bet it's much greater now. You can learn more about how they did it in an article on ProRepublica. I'll provide a link to it in the notes. Well, now the Biden administration is looking at creating a cap in the amount that could be in a Roth IRA. That makes Roth planning now even more important. Why does everyone love a Roth IRA? Well, in 1997, the Roth IRA was created to allow people to put away money and forego a tax deduction. In exchange, you get tax-free growth and tax-free distributions. So if you think that tax rates are going up, it may make sense to contribute to a Roth IRA. But not everyone can. The Clinton administration limited the Roth account to Americans who are making less than $110,000 or married couples making less than $160,000, and annual contributions were limited to $2,000. Fast forward to today, and now if you make less than $140,000 in 2021 or $208,000 jointly, you can contribute up to $6,000 if you're under 50 and $7,000 if you're over 50. In addition, you can convert assets that are currently in traditional IRAs into Roth accounts if you pay the taxes now. So over the next 5 years, while we're still in those lower tax brackets, it may make a lot of sense if you qualify to make Roth contributions. But what if you don't qualify? Well, there's always the backdoor Roth conversions, and we're not going to get into the details here, but it is an option, and so is a full conversion. Are you in an artificially low income tax bracket because you're in between jobs or something happened? Are you retired but not yet claiming your Social Security? It may make sense to convert some assets now while we're in the lower tax brackets into Roth assets. You pay tax now, but then you can have tax-free growth and tax-free distribution in retirement. And if taxes go even higher than the 2017 brackets, it may be an even better decision. There's never been a better time than the present to explore how a Roth conversion can help your financial situation. But if markets were to fall, it makes this strategy even better. You can convert assets while markets are down, pay the tax then, and then get the growth tax-free on the way back up. For those who converted in 2020 during the COVID pandemic, they are looking like geniuses right about now because they converted while the markets were down and were able to get the growth as the market has bounced back. It's always tough to pay tax now. I get it. Trust me, I want to pay as little tax as possible. But if the trade-off is to pay a little bit now to not pay any tax in the future, I will write that check all day long. The more assets that are in Roth IRAs, the less you pay in taxes. But the kicker here is that Roth IRA distributions do not count as provisional income, so they can't make your Social Security taxable. Let me say that again. Roth distributions in retirement don't make your Social Security taxable. It is possible to create a strategy where you either contribute or convert assets to Roth IRAs and pay taxes over the next 5 years at these low rates to reposition those assets for future distribution without tax. That is powerful. And if you own a business and have either a solo 401k or a corporate 401k with Roth eligibility, you can contribute up to $19,500 if you're under 50 and $26,000 if you're over 50, no matter what your income is. If you're a solo entrepreneur or you own your business with your spouse, make sure you check out my video, The 5 Reasons Why a Solo 401k is Better Than a SEP IRA, for more detail. Personally, I use powerful financial planning software and then can model how much and when to convert and what the potential impact on a financial plan is. Every situation is different. You hear me say this all the time. If you work with your tax and financial advisors, you too can create a Roth plan. Okay, let's talk about the next part of the strategy. And this is the powerful HSA, or health savings account. These are triple tax-free accounts that are part of a high deductible healthcare plan. These plans allow you to save and invest for the future by getting a tax deduction now, tax-free growth, and tax-free distributions if it's used for medical expenses. Huge benefit there, and a part of the zero tax bracket plan. You know why? Because just like Roth IRA distributions, HSA distributions do not count as provisional income and do not make your Social Security taxable. Now, currently, a family can contribute up to $7,300 into an HSA and $8,300 if you're older than 55. That can be huge growth as well. Proper planning can help you target a certain amount of growth in the HSA plan so that you cover your assumed health expenses in retirement. Once you reach age 65, you can withdraw the funds for any reason without any penalty. But you don't want too much in there, because if it isn't used for health care, you'll pay tax on the withdrawal like any regular income. So as you're putting this together, there's an optimal amount to have in the HSA, just like there's an optimal amount to have in a tax-deferred IRA or 401k. Okay, last part of the zero tax bracket strategy, permanent life insurance. Now, most people think of life insurance for the death benefit, but there are many benefits while you're alive. Now, I'm not one of those advisors running around saying that permanent cash value life insurance is the best thing since Netflix, but there is significant value in tax-free accumulation in the current low interest rate world. Did you know that after paying for insurance costs, extra funds put into cash value policies grow without taxes? And you can maintain access to those funds to use for any purpose. No approval needed from a loan officer and no penalty like in a retirement account. Now, typically in a whole life insurance contract, the interest rates credited are roughly between 4 to 6% based on current dividend rates and are never negative. And remember, those rates are not taxed. After taking into account expenses for the life policy, it's a very attractive addition in this low interest rate environment. Now, will it outperform the stock market over time in a Roth IRA? Probably not. I mean, I really doubt it. But will it do better than having money in a checking or savings account, CDs, or low-yielding bonds? It very well may, especially because it isn't taxed. If you earned 4% in one of these policies tax-free and were in the 22% tax bracket, you would have to earn 5.128% before tax to do better. What bank account, CD, or bond is paying that? They're currently not, and if interest rates continue staying low, they're not going to. It makes a good alternative and addition to the 0% tax bracket plan. All right, now that you know the secrets to creating a zero tax retirement, you can begin the process of planning. Because here's the hard part. You have to start now. The clock is ticking. We only have 5 years before these current tax rates likely sunset and go to higher rates. But if you start the process now, when you're in retirement, You can choose how to take your distributions between your HSA, your Roth IRA, and your traditional IRA, as well as your permanent life insurance contract. And that can be done to create a completely tax-free income while not making your Social Security taxable. Or the alternative, you could just keep deferring taxes into the future and deal with the tax bomb later. A tax-free future starts with proactive planning today. Get started by downloading my new ebook, Accelerating Your Path Toward Prosperity. I'll provide a link to it in the notes. So what do you think? Are you already creating your 0% tax bracket? Let me know in the comments. Do you have thoughts or comments on how to optimally do it? I'd love to hear from you. Put those in the comments. And if you enjoyed this video, make sure you give it a like, and of course, smash that subscribe button and hit the little bell so you know whenever I release a new financial planning video. Remember, financial planning is not an exact science. We don't know what returns or inflation rates will be, but we do know exactly what tax rates currently are and where they most likely are going. It's almost like having tomorrow's information today. Get clear, be clear.